Martin Wolf, Fixing Global Finance, Forum on Constructive Capitalism. In the book Fixing Global Finance, Martin Wolf dives into the intricacies of the global financial market, revealing both its strengths and vulnerabilities. The worldwide financial system has grown exponentially, with $140 trillion in financial claims existing today. This summary will guide readers through the financial market's abilities to spur growth and provide opportunities, as well as its complex and fragile nature. Explore the various reasons why financial markets are prone to meltdowns, such as lack of understanding, complexity, and volatility. Additionally, learn about the significant role of emerging markets in the global financial system and the importance of reforming financial institutions, such as the International Monetary Fund, IMF.
Financial markets and the age of crisis. Financial markets form the backbone of the global economy, offering benefits such as funding for new businesses, home buying, and insurance markets. Although finance has proven successful, it has its flaws. Financial markets operate on a pyramid of promises with the total financial claims worldwide surpassing $140 trillion. When these promises break, the world's economic engine sputters, resulting in bubbles, busts, and costly crises. The root cause of global financial markets being prone to meltdown include complexities unlikely to be grasped by the regulators, policymakers, and investors, rickety structures in emerging markets, and government risk-bearing. Financial institutions and investors have made mistakes and miscalculations over time. Consequently, the public sector ends up bearing the losses, which can lead to demanding monetary bailouts and economic recession. The risk and reward of private capital flows in emerging markets. Private capital flows can be a double-edged sword for emerging markets, providing much-needed funding while also destabilizing their economies. Commercial banks offering short-term credit are often the culprits behind sudden withdrawals of funds. Current account deficits caused by borrowed funds have led many emerging nations to devalue their currencies, which ultimately leads to collapse. Despite the potential benefits, emerging nations are turning away from large capital inflows, instead focusing on building their foreign exchange reserves and avoiding IMF bailouts. While they have not solved their financial problems, they have learned to moderate the unpredictable nature of entering cutthroat financial markets. The global finance system needs to address the problems to defend existing levels of financial integration. The risks and rewards of the U.S. as the world's primary destination for savings. The U.S. is the world's largest borrower and attracts the majority of global savings due to its high consumption rates. This has provided stability for global markets but poses risks, as seen in the 2007 subprime crisis. The savings glut, caused by decreased savings and increased investments in emerging nations and oil exporters, has made the U.S. an attractive destination for savings. However, this also means its financial markets are vulnerable to foreign influence. China, with its large trade surplus and foreign currency reserves, has become the largest saver and investor in history but faces challenges in pollution and income inequality. While the U.S. deficit cannot keep expanding, it can remain elevated for some time without serious consequences. Strategies for a stable global financial system. The global financial system needs to be reformed to reduce the boom-and-bust cycle and prevent crises. This can be achieved by lessening U.S. dependence, reducing punitive measures toward emerging markets, and creating an international bankruptcy process for sovereign debt restructuring. To stabilize currencies, proposed strategies include an emerging currency index, domestic currency finance, and sovereign debt restructuring mechanisms. The IMF should also be retooled to give it true legitimacy by allowing all member nations to participate in choosing its leader. China should use its money at home, and other rich, stable countries must absorb some of the world's excess savings. Finally, poor nations must create sound financial systems and lure foreign direct investment to achieve global financial stability.
Martin Wolf's book Fixing Global Finance provides a comprehensive analysis of the global financial market's interwoven structure and its propensities for crises. By dissecting the system, Wolf highlights the importance of addressing problems that arise from current account deficits, currency mismatches, and infrastructural inadequacies of emerging markets. In order to create a more stable and secure financial system, Wolf recommends a series of reforms, such as retooling the IMF, encouraging China to spend its excess wealth domestically, and integrating more countries into the world's savings. Ultimately, the book emphasizes the need for a more adaptable and resilient financial system that can support the growth and success of nations worldwide.